Hello everybody, my name is Mike Florin and I'm with Low Cost Mortgage. Today is your realtor update for the last week of July, July 28th, 2023. This year, we're over halfway into the year right now and it's been one heck of a ride. I'm going to show you a quick chart and it's going to show you that rates are going up and then down and then up and then down. And right now we're kind of towards that upper end of that up, right, for rates. Except the Fed just increased rates by another 0.25%. What does that really mean? Well, in the mortgage industry, there's a lot of smart people in the mortgage industry, right? There's thousands of people that are crunching numbers all the time trying to figure out what is the Fed going to do, what is the economy doing, and what's going to happen into the future, right? So with that being said, there's a lot of prediction that happens. Sometimes they get it right, sometimes they get it wrong. But typically, if the mortgage industry thinks the Fed's going to increase rates, a few days before, up to maybe 2 weeks before, they'll start increasing rates incrementally. And I'm going to show you on a chart here when I pop it up. You'll see that before the Fed announces an increase, well, the mortgage market already prices that in, and then the Fed announces their increase, and sometimes rates will come down, like they did the day of the increase. And then sometimes they'll go up, which has happened the day after the increase. Typically, see, the last 2 years have been weird. Every time, for the most part, that the Fed would announce an increase in rates, rates would come down right afterwards. And the main reason is the industry was pricing out more than what the Fed was going to increase. So, for example, this time they increased it a 0.25 percentage point. And if it was a year and a half ago or a year ago, the market would have increased the rates about 0.5 percentage point. Then the Fed comes up a quarter, then they would bring their rates down to where that quarter increase would have been. But this time, I think they've pretty much figured out what the Fed's going to do and where it's going to go. If you remember last month when the Fed announced no raise in the rate, rates went up, and that's because of different things that happened. So, for example, if the jobs report shows good numbers, which is bad for interest rates, or if inflation is showing that it's higher than what it should be, then you'll see everyone start to adjust. But in the mortgage industry, who were the players just 3 weeks ago have switched. It's kind of interesting. So we see a bunch of investors, and they were here, and their competition was here, and then something happens, and now they're here, and the other ones are now here. It changes all the time. So where we used to send most of our loan traffic to 2 outlets or so, right now we're sending it about 5 or 6 outlets. And a lot of those outlets are a little bit different. You could say you're chasing rate. I say we're chasing efficiencies. We're looking for people who can do it faster, cheaper, and are willing to take that risk and offer that lower rate to you. But that's one of the ways that we keep rates low, is we're constantly increasing our number of investors that make sense. We test them. For example, we just tested a VA and FHA outlet. It tested really good, and their rates are really low. So if you as a borrower or as a realtor, your borrowers fit within the confines of who and what that investor can take, your rates are going to be substantially better. But in the end, Fed increasing rate, Fed decreasing rate, are rates a little higher now than they were a few days ago? Yeah, they are. We're still solidly in the 6s, and with a little bit of money, you're getting down into the 5s. So if you have good credit on VA, FHA, you're going to be low 6s. 1 point gets you down into the high 5s. At least that was today. You'll see it in the email. Conventional, it's about 0.25% or so higher than Govy typically, maybe 3/8 depending on the scenario. There's a big difference. I want to talk about one more thing here before we go. And I priced out scenario this morning, and it was a 620 VA. A 620 VA and a 640 VA on FICO score are substantially different in pricing. What we did is we compared 620 and 660 just to show, hey, if you do these things, we can get your credit up. And their interest rate was 0.75 percentage point better. It's 0.75 percentage point lower. And a lot of times all you have to do is pay down a credit card to get the extra bump. So it's it's better to know what to do earlier in the process than when you're under contract. So for you realtors, if you have a borrower and they're kind of borderline in some capacity, have them talk to a mortgage professional. They'll typically tell them, pay down your credit card debt, pay it down to below 10% of its max. I'll do a more in-depth video on that. But if the sooner they know that, and the sooner that your mortgage person can get your borrowers lined up correctly, their score starts to increase, and it's a much better experience for everybody, cheaper for everybody. So anyways, Mike Florin, Low Cost Mortgage. Have a great day. And if you need anything, give us a call. Talk to you later. Bye.